We always worry about the missiles, but what if the true war is fought with ledgers, not lead? We expect a financial earthquake to start on Wall Street, but this one began 7,000 miles away. Let's talk about Shanghai, 2025. It wasn't a press conference, it was a formal invitation. China quietly offered every central bank in the world a new, fully insured place to store their gold. The destination? Not the Federal Reserve Bank of New York. The destination was Shanghai. This was not a diplomatic gesture. It was a declaration, a shot fired across the bow of the global reserve system. For decades, the U.S. dollar has been the world's trusted landlord. It holds the keys to the kingdom. If you trade oil, if you trade wheat, you settle the account in dollars. This is called dollar hegemony. The system runs on one simple thing: trust. But trust, like any other commodity, can be recalled. When China issued that invitation, they were essentially saying, why trust your rival to hold your wealth? They were offering an alternative, a safe house for wealth that doesn't rely on American goodwill. The vaults underneath the streets of New York hold the world's faith. If that faith moves, we're looking at a potential $33 trillion evacuation, a gold exodus. Washington kept firing sanctions. Beijing just opened a new safety deposit box. That is the financial World War III that has already begun. Not with bombs, with banks. We are already in the battle. We just didn't hear the trigger pull. We all know the definition of insanity, doing the same thing and expecting a different result. Yet, in economic policy, this is standard operating procedure. Why do leaders consistently reach for the one lever guaranteed to cause a global catastrophe? We must travel back to 1930. The economy was reeling. The political imperative was clear: do something. That do something was the Smoot-Hawley Tariff Act. It was designed to protect American farmers and factories. It was political armor. Instead, it became an economic neutron bomb. The world retaliated instantly. Trade routes seized up. Global commerce didn't just slow down, it fell off a cliff. The Great Depression deepened, swiftly, severely, globally. This wasn't mere incompetence, it was an exhibition of the action bias. In behavioral economics, action bias describes the urge to act, to move, to intervene, even when inaction is the rational choice. When crisis hits, the public doesn't forgive patience, they demand visible effort. Doing nothing is political death. So, leaders choose the high-profile disaster. They choose the tariff. It looks tough. It looks like leadership. It provides the satisfying illusion of control. The long-term economic damage, that becomes someone else's problem. Today, the playbook for 2026 is being written. The rhetoric is the same. The historical warning is louder than ever. The ghost of 1930 is not a footnote, it is an active blueprint. Be suspicious of any policy that looks powerful but relies on historical amnesia. The most catastrophic move is often the one that feels the most decisive, and right now, the ghost is writing policy. What is the true target of a trade war? We look at the headlines: steel, semiconductors, soybeans. Boring. But that is just the camouflage. The real weapon isn't a tax on a thing. It is an assault on an idea. The U.S. dollar has a superpower, and it is not the military. It is the network effect. What is that? Simple peer pressure. The dollar is the world's most trusted social network. Everyone uses it because everyone else already does. It is economic FOMO. This universality is its true strength, far more powerful than any gold reserve. Now, consider that hypothetical 2026 tariff spike. It looks like a simple change in the customs schedule. It isn't. Think of it less as a revenue generator and more as an economic IED. Its true purpose is to force friction.
When Washington fires a tariff, they're not just punishing competitors, they're penalizing their own users. They're telling allies, enemies, and everyone in between, we might change the rules on a whim. The stability you rely on is negotiable. This is how you shatter trust. When participating in the dollar network becomes too expensive, too unpredictable, or too political, smart players look for the off-ramp. This is not just China, this is Europe, this is Japan, even our closest friends. They do not want to be caught in the next crossfire. The tariff is not about collecting duties, it is about actively weakening the network that underpins American economic dominance. By repeatedly using the dollar system as a weapon, the U.S. is unknowingly training the world how to survive without it. It is the ultimate act of self-sabotage. The weapon aimed at Beijing ends up hitting Wall Street. We worry about inflation, we track interest rates, but what happens when a currency doesn't just lose value, but loses its entire place in the world? What happens when a global king decides to abdicate? For centuries, the British pound sterling was the backbone of global finance. It was the standard, the ultimate safe haven. It was the dollar before the dollar even knew how to tie its shoes. But reserve status is not a birthright. It is a highly demanding, utterly unforgiving performance review. The decline of the pound was not a sudden collapse. It was a slow, deliberate bleeding. Great Britain had won 2 world wars, which is a glorious thing, but victory came with a colossal invoice. The nation was exhausted, financially hollowed out, and structurally indebted. They were victorious, but they were effectively broke. The world knew it, and finance fundamentally is built on trust. When the world realized Britain could no longer afford to be the world's banker, that trust began to erode, slowly at first, then suddenly. The shift, formalized later, was inevitable. Global trade needed a new pillar of reliability. That pillar became the American dollar. The demise of the pound sterling is the ultimate economic autopsy. It shows us that dominance is fragile. It's a stark historical blueprint. Empires fall not when they lose military might, but when the global community decides their promises are no longer good enough. The lesson is simple, and it echoes today. Complacency is the most expensive mistake in the history of money. Always. How does a nation that owes $33 trillion still manage to call the shots globally? It's the question everyone whispers in Geneva and Beijing. The answer is simple and terrifying. That massive debt is not just a ledger entry, it is the very foundation of American power. We are talking about the $33 trillion held by foreign nations in U.S. assets. This sum is now larger than our entire annual gross domestic product. Think about that for a moment. The world has essentially bought America, piece by piece, and we call this our greatest strength. This is financial irony at its absolute peak. It's also the $33 trillion sword of Damocles. A significant chunk of this foreign money is held in U.S. Treasury bonds. These bonds are essentially government IOUs, promises to pay back the principal plus interest. When foreign central banks buy our bonds, they're financing our lifestyle, our wars, and our safety nets. They're the world's largest creditors. The game works as long as everyone agrees that the U.S. Treasury is the ultimate safe deposit box. But what happens if they don't? What happens if the largest holders, say China or Japan, begins dumping these bonds onto the open market? The price of those assets crashes. When the price of a bond drops, its interest rate, its yield, skyrockets. Suddenly, the cost of borrowing for the U.S. government explodes. It's not merely an economic slump. It's a forced massive interest payment on our existing debt. We would be paying a premium just to keep the lights on. It would trigger a debt crisis by way of collective distrust. We track this foreign money flow not out of paranoia, but because the fuse is already lit. The world relies on the U.S. dollar, and the U.S. relies on the world's belief in it. Our dominance is not absolute. It is a faith-based system, and the world holds the faith and the ledger. That is the vulnerability no politician dares to fully acknowledge. We all feel it, don't we? That nagging suspicion about the dollar? Is the king still wearing his crown? This is not a theoretical argument debated in some smoke-filled back room. This is happening now, in plain sight. Forget the pundit shouting matches. We look at the numbers governments actually use. We're talking about data straight from the International Monetary Fund, the IMF. This is not prophecy. It is cold, hard accounting. Just a few short years ago, the dollar held over 62% of all global currency reserves. It was the undisputed, unchallenged champion. Today, that share has slipped sharply. It is now below 56%. 6 percentage points gone. 6% of global trust